Only a few hundred people on Earth get to influence the price of energy that dictates your life. On this video, I'm going to show you who those players are. In the last episode, you saw the architecture, the stadium, ice, the referee, plats, and the whole gatekeeping. But the question now is, in this analogy, who actually gets on the field? Who plays the game that decides the price of the world's energy? It isn't thousands of companies. It isn't even tens of thousands of traders. It's not even hundreds of institutions, it's tens of businesses. No more than 40 firms influence more than 95% of the price of energy around the world. That's a few hundred people, and they move every market you feel in your daily life. Let me introduce you to the real VIPs. There are only 5 categories of institutions that consistently move the needle in global oil and energy derivatives, which sets the price. Everyone else is just noise. So first off, we have the energy majors. These are the source of production. ExxonMobil, Shell, BP, Total Energies, Chevron, Saudi Aramco, and the Chinese national oil companies. These are the guys that own the molecules. They produce crude oil, natural gas, and generate power and refine oil products. These companies lock in supply not just for next year, but for the next generation. 20 or 30-year contracts that guarantee who gets the energy before it even exists. When a big energy company acts, prices move because they control actual supply. So one quiet decision to take the energy or hold off can reshape the entire future price outlook. Second, we have the trade houses. These are the owners of the supply chain. Trafigura, Vitol, Gunvor, Mercuria, Glencore. These are the merchants. They run the world's energy supply chain, buying from producers, selling to refiners, moving liquid natural gas, and balancing power flows. They do this everywhere across every system. So all those flows merge into one enormous portfolio of risk. And when you hold that much risk, you end up behaving like a central bank of energy, adjusting flows, storage, timing, and hedges in ways that quietly steer the pricing environment to protect your portfolio. They live and die by spreads, arbitrage, and timing. They are the ones providing the two-way trading flow that keeps the market active. Number 3, we have the banks, who act as the bridge to the exchange. If you want to trade on ICE, CME, SGX, or any other energy exchange, you can't just log in and start trading. You have to go through what's called a clearing member. This is a bank or institution big enough to have a direct line into the clearinghouses that run the system. And these clearing members don't just work with anyone. It has to be worth their while. If you've seen The Big Short, you'll remember the scene where they say you need an ISDA to play at the big boys table. Energy markets work the same way. Unless you already look like a major institution with size, capital, and history, you don't get access. You don't get onboarding. You don't even get a conversation. So before you even reach the market, you hit the first wall. Access is controlled by a handful of clearing banks: JP Morgan, Goldman Sachs, Citi, Morgan Stanley, SocGen, BNP Paribas, ABN AMRO, the financial gatekeepers of the entire energy system. They decide who gets access, how much margin you need, how much size you're allowed to trade, and whether you get shut off during a crisis. Most people never even see this layer of power, but it determines who gets to play the game at all. At number 4, we have the hedge funds. Now this is the institutional money flow. First off, there are the slow giants. These are pension funds, index trackers, sovereign wealth funds, and institutional asset managers. You've heard of the names like BlackRock, Vanguard, and PIMCO. They don't move fast, they move massive. And when even a fraction of their capital rotates into energy, the big contracts take the weight of it, and you feel it later at the pump and on your electricity bill. Hedge funds also do a lot of the speculating in the big futures contracts. Citadel, Millennium, DE Shaw, these are the fast movers. They take enormous bets in crude, gas, and power, and they swing curves violently. And finally, you have the systematic funds, the momentum players known as CTAs. They follow simple trend signals, and when those models flip, billions of dollars move with them. Their sheer size often exaggerates market moves in both directions. And finally, we have number 5, the independent market makers. These guys are the hidden glue that keeps the market going. Onyx, the company I run, is consistently the #1 liquidity provider in global energy contracts and has been for years. We sit in the flow. We see the pressure points. We keep the market moving when nobody else wants to take the other side. And alongside us are the ultra-fast players, the high-frequency traders like DRW, Optiva, IMC, Jump, Tower. They aren't setting big trends, they're keeping the screen alive. They execute thousands of trades a second, arbitraging tiny moves across crude, gas, power, and products. But here's where everything clicks. There is a hierarchy in this world, a structure of power that explains who actually drives the market. You've now seen the players, but here's the twist. Even inside the club, not everyone understands how the price is actually created, because the price doesn't come from supply and demand curves. It doesn't come from headlines. It doesn't come from the free market. It comes from a process, a private ecosystem of pricing windows, methodologies, signals, and behaviors. A process run by institutions that most people have never heard of. In the next video, I'm going to take you inside that process step by step. I'll show you the mechanism that creates the price of global energy long before it reaches your business, your investments, or your cost of living. Once you see it, you'll never look at the economy the same way again. Hit subscribe, turn the bell on, and get ready for the coming storm.